Most people assume that economic success comes from hard work, innovation, and fair competition. They believe that modern economies operate like neutral playing fields, controlled by transparent rules designed to benefit everyone. But what if the system isn't neutral at all? What if the global economy has been silently shaped, redirected, and engineered to ensure that a small elite always wins no matter what happens? And what if the real mechanics behind this manipulation are hidden not in conspiracies, but in plain policy decisions that most people never question? For decades, economists, governments, and financial experts have repeated the same message. Markets are efficient, incentives are fair, and everyone has an equal opportunity to rise. Yet beneath this reassuring narrative lies a structure built on imbalances that didn't appear by accident. These imbalances were designed, reinforced, and expanded across generations, creating a world where economic power concentrates upward while the majority struggles to keep pace. To understand how this system emerged, we must trace a series of decisions often technical, often unnoticed, that slowly bent the rules of global finance. Long before modern capitalism took shape, economies were grounded in physical resources and tangible production. Wealth was tied to land, minerals, labor, and real goods created through effort. For most of human history, this material foundation limited how much influence governments and elites could exert. You couldn't create wealth out of thin air, and you couldn't accumulate power without producing something of actual value. But as trade expanded, banks emerged, and finance gradually evolved. A new kind of power became possible: the power to control money itself. In the early days of banking, money was directly linked to precious metals, especially gold. This limited how much governments could spend and how much bankers could lend. It constrained speculation and prevented runaway inequality. But it also limited how fast economies could grow and how quickly elites could consolidate financial power. Over time, pressure grew to loosen these restrictions, and the seeds of a new system were planted, one where money could be manipulated. By the 19th century, major empires recognized the strategic advantage of controlling currency. Britain, France, and later the United States began building financial systems that extended far beyond their borders, allowing them to dictate global trade through monetary leverage. The gold standard was still in place, but cracks were forming. At the same time, private banking families and emerging multinational corporations gained influence over national policies, shaping them to maximize profit even during instability and war. The First World War accelerated the shift. Governments abandoned the gold standard to print money for military spending, discovering a dangerous but irresistible truth: monetary expansion could temporarily create wealth even without real resources behind it. After the war, countries tried to return to hard money, but the world had changed too much. Debt soared, inflation surged, and financial institutions accumulated enormous power by financing reconstruction. The game was changing, and the line between public good and private benefit was blurring. The Great Depression exposed the fragility of the system. As markets collapsed and unemployment surged, governments sought expertise from private bankers, economists, and institutions that had their own interests at stake. Policies that claimed to save the economy frequently benefited financial elites first. For example, bailouts protected large banks while small businesses collapsed. This pattern would echo repeatedly through future crises. The bigger the institution, the more likely it was to be rescued. After World War II, the world's major powers sought to rebuild a stable global economy. In 1944, the Bretton Woods Conference established the International Monetary Fund and the World Bank, institutions designed to stabilize currencies and support reconstruction. But these organizations also centralized global financial control. Nations needing assistance were required to implement policies dictated by distant technocrats, policies often aligned with the interests of powerful countries and corporations rather than local populations. The Bretton Woods system tied global currencies to the US dollar, which was backed by gold. This gave the United States enormous influence. Global trade required dollars, and access to dollars meant access to economic survival. But even this system was built on a contradiction. For global trade to expand, the United States had to supply more dollars abroad, meaning it had to run deficits. Over decades, those deficits eroded the credibility of gold convertibility, setting the stage for a dramatic shift. In 1971, the world reached a breaking point. Foreign nations held more dollars than the U.S. could convert into gold. Confidence was collapsing quietly. Behind the scenes, then, in one televised address, President Richard Nixon suspended the dollar as a link to gold. What sounded like a temporary measure became permanent. Overnight, the global economy transitioned from hard money to a system where currencies were backed by nothing but trust. This moment allowed governments and central banks to expand money and credit without limit. This shift opened the door to unprecedented financial manipulation. With no physical anchor, money could be created or destroyed at will. Interest rates became tools of political strategy, debt became the primary fuel of economic growth, and financial institutions freed from many historical restraints began engineering complex instruments that concentrated wealth while dispersing risk onto the public. The economy no longer grew based on how much value was created, but on how much credit could be extended. Throughout the 1980s, deregulation accelerated. Governments around the world embraced free market ideology, promising efficiency and opportunity. But deregulation also enabled speculative bubbles, corporate monopolization, and vast capital flows controlled by a few major banks. Privatization handed essential services to corporations. Tax systems shifted in ways that favored capital over labor. Each reform claimed to help the economy, but in practice, the benefits flowed upward. By the 1990s, global financial markets had become deeply interconnected. Investors could move trillions across borders instantly, punishing countries that failed to conform to preferred policies. The Asian financial crisis, the collapse of Russia's economy, and Latin America's debt emergencies all revealed the same pattern. When developing countries opened their markets, capital surged in. When difficulties emerged, that capital fled overnight, causing catastrophic crashes. Meanwhile, international lenders profited from both the boom and the collapse. In each of these crises, rescue packages from global institutions came with strict conditions: reduced public spending, deregulated industries, privatized resources, and open access for foreign corporations. These measures often deepened poverty, but expanded corporate influence. Economic manipulation wasn't hidden in back rooms. It was embedded in official policy frameworks presented as stability and reform. The early 2000s saw the rise of financial derivatives, complex products that multiplied profits for institutions while shielding them from accountability. Banks took enormous risks, confident that governments would rescue them if their gambles failed. This perverse incentive contributed directly to the 2008 financial crisis. When the housing market collapsed under the weight of excessive speculation, millions lost their homes, jobs, and savings. But major institutions received massive bailouts. The aftermath of 2008 marked another turning point. Central banks began printing money on an unimaginable scale through quantitative easing. This was presented as a recovery tool, but the effect was clear. Asset prices skyrocketed, while wages stagnated. Those who owned stocks, real estate, and businesses became dramatically wealthier. Those who relied on salaries saw their purchasing power erode. Inequality surged, 2 levels not seen in more than a century. Meanwhile, low interest rates encouraged governments and corporations to borrow endlessly. Global debt tripled within a decade. The economy became dependent on continuous credit expansion, and central banks became the most influential economic actors in history. Their decisions made by unelected officials could move markets, shape national policies, and determine whether a country prospered or collapsed. The pandemic of 2020 pushed these trends further. Governments and central banks created trillions out of thin air to stabilize economies. The line between monetary and fiscal policy effectively disappeared. Financial markets saw it even as real economies struggled. Billionaires' wealth increased dramatically while millions of small businesses permanently closed. The system had fully transformed into one where financial power, not productive activity, determined outcomes. Today, economic manipulation continues through more subtle mechanisms. Corporate lobbying influences legislation. Rating agencies can destabilize nations by downgrading their credit. Investment funds can pressure countries to change labor laws or environmental regulations. And financial technologies like high-frequency trading and algorithmic markets create advantages, accessible only to institutions with immense resources. Most people still believe markets respond naturally to supply and demand, but markets today respond more often to policies, signals, and incentives engineered by central banks, governments, and financial elites. Stock markets rise not because companies innovate, but because interest rates fall. Housing prices increase, not because supply shrinks, but because credit expands. Entire economies grow not because workers become more productive, but because money becomes cheaper. This structure explains why wealth continues concentrating in fewer hands. Those with access to financial assets benefit from monetary expansion. Those without assets fall behind. In many countries, the richest 1% control more wealth than the bottom half combined. And because political power follows economic power, these elites shape tax laws, trade policies, and monetary strategies to reinforce their advantage. Attempts to reform the system repeatedly fail because the institutions capable of reforming it are influenced by the same interests that benefit from its current form. Proposals for stricter bank regulation, progressive taxation, or limits on speculative finance are often weakened or blocked before they become law. The result is a cycle. Crises expose the flaws. Reforms are demanded, and yet the structure remains intact. Even now, new risks are emerging. Artificial intelligence accelerates financial speculation. Digital currencies challenge traditional banking. Nations shift away from the dollar, threatening the existing power hierarchy. And global debt levels continue climbing to unsustainable territory. Any one of these forces could trigger another transformation, one that once again reshapes the economy without the public fully realizing what has happened. And this brings us to the mystery introduced at the beginning. How economic systems come to benefit the few while appearing fair to everyone else. The truth is that manipulation rarely looks like manipulation. It looks like policy. It looks like stability. It looks like reform. It is built into a structure that has evolved over decades, shaped by decisions that rewarded concentration rather than distribution. From this story, 3 key takeaways emerge clearly. First, economic rules are not natural. Laws, they are designed, and those who design them shape who wins and who loses. Second, financial power grows faster than productive power, meaning wealth will continue concentrating unless structural rules change. And third, the next major shift in the global economy may happen quietly, just like past ones, reshaping our world long before most people understand what changed. If this breakdown helped you see the economy through a more critical lens, consider staying connected with the channel. The more we understand these hidden mechanics, the better prepared we are for the transformations still to come.